Welcome to SMC Foundations Think Like Institutions. Let's be very clear from the start. This is not a strategy series. This is not about entries. This entire playlist is designed to do one thing: to rip out that old retail thinking and replace it with solid institutional decision logic. So let's dive right in and tackle the biggest, most costly mistake that almost every trader makes. You glance at a chart and you think, yeah, I see the trend, right? Well, that single belief, that gut feeling, is very likely the exact reason you keep buying the absolute high of a move and selling the absolute low. In this session, we're going to stop treating market structure like some vague buzzword. It's going to become a strict black and white framework built from higher highs, higher lows, lower highs, and lower lows. Think about it. When your idea of a trend is just, hey, lots of green candles, it must be an uptrend. What happens? You end up jumping in late, you place your stop loss right where the big players need liquidity, and your entire bias flips on a dime with every single strong candle. The cost of this is massive. You're trading against the dominant flow of the market without even realizing it. By the end of this, you are going to see trend and direction in a completely new light because you'll only trust what the structural sequence actually confirms. Okay, let's manage some expectations right now. What we're about to cover is not an entry model, not even close. Think of this as the foundational language you absolutely must be fluent in before you're even allowed to think about execution. So here's the institutional definition, plain and simple. Market structure is the sequence of confirmed swing highs and swing lows that defines what price is doing. It is not your feeling, it's not the news, it's not your opinion about the direction. And why do institutions care so much? Because this sequence tells them exactly where the liquidity is sitting and, crucially, where previous levels have been broken or respected. In a bullish structure, you're looking for a simple repeating pattern: higher highs and higher lows. Think of it like walking up a flight of stairs. You take a step up, breaking the last high. That's your higher high. Then you take a small step back, but not all the way down. That's your higher low. And then you go again. A bearish structure, well, it's just the opposite. You're walking down the stairs. You're making lower lows and lower highs. Each new low breaks the previous one, and every little rally just fails to get back to the last high. Now, this right here, this is a total game changer. It completely reframes the question you should be asking yourself. A professional doesn't look at a chart and ask, is the price going up? That's a retail question. The professional asks, is price printing a clean higher high, higher low sequence? Or a lower low, lower high sequence? Or is it just chopping around in a range? If the structure is unclear, they don't force a trade. They just wait. So if you ever catch yourself thinking, well, I kind of see a trend here, that's your alarm bell. You're trying to force a pattern into what institutions just see as noise. All right, enough theory. Let's get practical and look at a clean example to see how this all comes together into a process you can actually repeat. Let's walk through this one step by step. First, price prints a nice clear low. Then it rallies up and creates a swing high. Now, the next move down is key. It creates a higher low. Notice it did not break that first low. Then, price pushes up hard and smashes through the previous high with real momentum. That break is what confirms the new higher high. And in doing so, it locks in that previous low as a valid, confirmed higher low. That right there, that's the sequence. We all have that little voice in our heads, right? The one that says, it's already moved up so much, I'm too late, it has to reverse now. That voice makes you fight clear trends. The professional reframing is brutally simple. As long as that higher high, higher low sequence is intact, your opinion means nothing. The structure is the bias. You don't get to question that bias until the sequence is clearly broken. Okay, time for a quick gut check. No hesitation. Looking at this chart, this exact sequence of highs and lows, do you classify this as a bullish structure, yes or no? If your answer is anything other than an immediate, confident yes, then you have absolutely no business looking for a long trade here, period. All right, we've seen what clean looks like. Now, let's look at where it all falls apart. This is a critical distinction because this is where most traders get wrecked. You've seen this a million times. Price is just chopping sideways, highs and lows are overlapping, there's no clear direction. But the retail trader starts drawing trend lines, calling every tiny peak a lower high. They force a bearish story and they decide to sell the trend. What happens next is so predictable. Their entry and their stop loss just create a big pool of liquidity, and price, like a magnet, spikes right up to grab that money, stopping them out. And then they go online and blame manipulation. So here's the professional rule, and I want you to burn this into your mind.
If you cannot mark at least 3 connected, clean swings forming a sequence, like a low, a high, and a higher low, you classify the chart as non-trending. And in a non-trending market, execution is forbidden. Period. No excuses.
So why does such a simple concept fail so many traders? It really comes down to two things: speed and ego. Speed is that impatience, flipping your entire market bias because of one big candle instead of waiting for a confirmed structural break. And ego is that need to be in the action, to have a label for every single wiggle on the chart to justify being in a trade. When you do that, your behavior just creates predictable pools of money for institutions to target. The cause and effect is crystal clear. Your impatience in labeling structure leads you to see false trends. That leads to you being positioned on the wrong side of the market, and that wrong side position becomes the very fuel for the next real move against you. The mental shift you need to make is to pause and ask yourself this one question: has structure actually shifted, or am I just feeling uncomfortable with this pullback? So let's solidify all this. We're going to take market structure from being just another tool in the toolbox to being a hard, non-negotiable filter you use for every single decision you make. Let's boil institutional thinking down to 3 core truths. 1. Higher highs and lower lows are not an entry signal. They are for context only. 2. Trying to predict a shift before it's confirmed is exactly where traders try to be a hero and where they consistently lose. And 3. Until a prior major swing is clearly broken, you are not allowed to call it a trend change. It's that simple. Institutional thinking is honestly kind of boring. It's just incredibly consistent. They map the high time frame structure, they map the low time frame structure, and they only look for trades that agree with that map. So here's the internal thought you need to install. If the sequence is intact, I follow it. If the sequence is unclear, I do nothing. This simple idea turns market structure from a YouTube buzzword into a powerful, decisive execution filter. From this point forward, your mental loop is simple. Step 1, you mark the obvious swing highs and lows on your chart. Step 2, you only label them as a higher high or a lower low after a previous swing is clearly broken. Don't jump the gun. And step 3, if you can't connect at least 3 points to form a clean sequence, you have no bias and you have no trade. You sit on your hands. So, the next time you open a chart, I want you to change your first question. It's not where do I enter anymore. It is now, what is the current structural sequence? And if you can't answer that question in less than 10 seconds, you close the platform. In our next session, we're going to go even deeper into what makes a swing high or low strong versus weak. So mastering this lesson first is absolutely required. Look, this course is built to correct your execution mistakes, not just to entertain you. So if this explainer helped remove a false belief and give you some clarity, please support the course. Like the video, share it with that trader you know who just can't stop buying the top of every move, and make sure you subscribe so you don't miss the next required lesson. This is SMC Foundations. Think like institutions. We always build our context first. Execution comes much, much later.